Have you ever wondered why some people seem to handle money effortlessly, while others struggle no matter how hard they try? In today's video, we're diving deep into the psychology of money, the rules, lessons, and mindset shifts that can change the way you earn, save, and invest forever. Stick with me till the end, because these are the exact principles that can help you build real wealth, stay financially stress-free, and make decisions that actually work for you, not just on paper. Chapter 1. No one is crazy. When it comes to money, no one is crazy. People make financial decisions based on their life experiences, not just numbers, charts, or advice from experts. We often look at someone and think, why would they invest like that? Why take such a big risk? Why avoid investing completely? Why save every dollar? Why spend so freely? From the outside, it can look irrational. But every financial decision makes sense to the person making it, because it's shaped by what they've lived through. Imagine two people with the same income and education. One trusts the stock market completely, the other refuses to invest. Why? Maybe the first person grew up watching their parents slowly build wealth through long-term investing. To them, the market represents opportunity. The second person may have watched their family lose everything during a crash. To them, the market represents danger. Both reactions are logical, based on personal experience. That's why financial advice doesn't work equally for everyone. It assumes people see money the same way. But no two people share the same financial timeline. The year you were born matters. The economy you entered as an adult matters. Your childhood environment matters. Someone who grew up with very little may see money as protection and safety. They might avoid risk and focus on security. Someone who grew up comfortable may see money as a tool for growth and feel confident taking bigger risks. It's not about intelligence, it's about perspective. And perspective shapes behavior. We also like to believe we're rational with money, but we're emotional. When markets go up, we feel confident and optimistic. When markets fall, fear takes over. Even if we know that markets recover over time, panic can override logic. That's because money represents more than numbers. It represents freedom, survival, stability, and control. When those feel threatened, emotions speak louder than reason. This is why behavior matters more than knowledge. You don't need to be the smartest investor in the room. You need patience. You need discipline. You need emotional control. At the end of the day, financial success isn't about beating everyone else. It's about understanding yourself. When you realize that no one is crazy, including you stop judging others and start making smarter, calmer decisions. And that's where real wealth begins. Chapter 2. Luck and Risk. When we look at successful people, we often focus on their intelligence, hard work, or strategy. And yes, those things matter. But there's something else that plays a huge role in every financial story: luck. And its twin brother, risk. Every outcome in money is a mix of both. Some people succeed because they worked hard and made smart decisions, but they were also in the right place at the right time. Others fail, not because they were foolish, but because circumstances turned against them. Two people can make the exact same decision. One becomes wealthy, the other struggles. What made the difference? Timing, environment, opportunity, chance. That's luck, and we don't talk about it enough. We love stories of billionaires who dropped out of college and built empires. But for every one of those stories, there are thousands of people who took the same risk and failed. We just don't hear about them. This doesn't mean success is random. Hard work increases your chances, but it does mean we should stay humble. When we succeed, it's easy to believe we are smarter than everyone else. When we fail, it's easy to believe we are terrible with money. Both reactions are dangerous. Understanding luck keeps you humble in success. Understanding risk keeps you compassionate in failure. Think about it. If you invest during a long bull market, you may believe you're a genius. But maybe you simply entered the market at a lucky time. If someone starts a business just before a recession, they may fail, even if their idea was strong. That's risk. And risk is always present. The problem is, we only see the visible winners. We don't see the silent failures. This creates a false picture of how the world works. We assume success is purely skill. We assume failure is purely stupidity. But reality is more complicated. That's why comparing yourself to others can be dangerous. You don't know their full story. You don't know how much luck helped them or how much risk hurt them. The smarter approach? Focus on what you can control. You can't control luck, but you can control your behavior. You can diversify your investments. You can avoid putting everything into one bet. You can stay patient during uncertainty. Instead of trying to become extremely wealthy overnight, aim to become financially stable over time. Because when you respect both luck and risk, you stop chasing extreme outcomes. You build resilience instead. And resilience is what keeps you in the game long enough for luck to work in your favor. In money, survival is success. Stay humble in good times. Stay patient in bad times. And remember, your results are never 100% you. They are always a mix of skill, risk, and luck. Understanding that changes everything. Chapter 3. Never enough. There's a dangerous mindset that quietly destroys financial success. It's called never enough. No matter how much someone earns, saves, or achieves, they always want more. And wanting more isn't always bad. Ambition can push you forward. It can help you grow. It can inspire progress. But there's a line, and when that line disappears, satisfaction disappears with it. History is full of people who had more money than they could ever spend, yet they risked everything for just a little more. Why? Because comparison is powerful. It's not about having enough. It's about having more than someone else. When your financial goals are based on comparison, they never end. There will always be someone richer, someone more successful, someone living a bigger lifestyle. And if your happiness depends on beating them, you will never win. The problem with never enough is that it pushes people to take risks they don't need to take. Imagine you already have financial security. Your family is safe. Your future is comfortable. But you see others making bigger returns, building larger businesses, living flashier lives. So you stretch, you take bigger risks, you borrow more. You gamble what you already have, not because you need to, but because you want more. And sometimes that desire destroys everything. The hardest financial skill isn't earning more money, it's knowing when you have enough. Enough doesn't mean quitting. It means defining what is truly important to you. Freedom, time, peace of mind, security. If you know what enough looks like in your life, you can stop chasing endless upgrades. Many wealthy people aren't the ones who earn the most. They're the ones who control their desires. They understand that wealth is what you don't see. It's the money saved, the risks avoided, the lifestyle you could afford, but choose not to. True wealth is not about showing power. It's about having control. And control starts with being able to say, this is enough. Because once you cross the line of enough, you start risking what you need for something you simply want. And that trade is rarely worth it. Financial success isn't about reaching infinity. It's about reaching stability and protecting it. The moment you define enough, money stops controlling you. And that's when you become truly wealthy. Chapter 4. Confounding compounding. There is one force in finance that looks simple, but is incredibly powerful. It's called compounding, and most people underestimate it. Compounding is when money earns returns, and then those returns start earning returns too. It sounds basic, but over time it becomes extraordinary. Imagine investing a small amount consistently. In the beginning, growth feels slow, almost boring. Nothing dramatic happens. But then something changes. The growth starts accelerating, not because you invested more, but because time did the heavy lifting. That's the magic of compounding. It rewards patience more than intelligence. Take the example of some of the world's most successful investors. Many of them didn't become wealthy because they earned the highest annual returns. They became wealthy because they stayed invested for decades. Time was their biggest advantage. Compounding works like a snowball rolling downhill. At first it's small, then it picks up more snow, and eventually it becomes unstoppable. But here's the problem. Compounding only works if you don't interrupt it, and most people interrupt it. They panic during market crashes. They withdraw investments too early. They chase quick profits instead of long-term growth. Every time you stop the snowball, you reset its size. The secret to building wealth isn't about making huge gains quickly. It's about earning reasonable returns for a very long time. Small gains, plus, long time, massive results. But patience is hard. We live in a world that celebrates speed, fast money, fast growth, overnight success. Compounding doesn't look impressive in the short term. In fact, it can feel disappointing at first. The biggest growth usually happens in the final years, not the beginning. That's why many people quit too early. They don't stay long enough to see the real power. And compounding doesn't apply only to money. It applies to habits. If you improve just a little every day, that growth compounds. If you save consistently, even small amounts, that discipline compounds. If you invest in your skills over time, your opportunities compound. Success isn't explosive. It's exponential. But exponential growth requires endurance. The biggest financial mistake isn't making a bad investment. It's failing to give a good investment enough time. So the real question isn't, how can I earn the highest return? It's, how long can I stay consistent? Because in the world of money, time beats talent, and patience beats power. Compounding feels slow, until suddenly it doesn't, and by then, it can change your entire life. Chapter 5. Getting wealthy versus staying wealthy. There's a big difference between getting wealthy and staying wealthy. Getting wealthy often requires boldness. Staying wealthy requires caution. Getting wealthy can come from taking risks, starting a business, investing early in something new, betting on an idea others don't believe in. It takes optimism. It takes confidence. Sometimes it even takes luck. But staying wealthy? That's a completely different skill. Staying wealthy is about survival. It's about protecting what you've built. It's about understanding that one big mistake can erase years of progress. Many people know how to take risks. Very few know when to stop. History shows us something important. Plenty of people have made fortunes, but not everyone keeps them. Why? Because the mindset that builds wealth is not the same mindset that preserves it. To get wealthy, you might need to believe, this will work. To stay wealthy, you need to believe, this could fail. That shift changes everything. Staying wealthy requires humility. You accept that markets can crash, businesses can collapse, unexpected events can happen. So instead of risking everything for maximum growth, you build margins of safety. You keep cash reserves. You avoid extreme leverage. You don't put all your money into one idea. You understand that survival is the ultimate strategy. Because if you survive long enough, you can always recover. But if you lose everything, you're out of the game. The most successful long-term investors aren't the ones who make the highest returns every year. They're the ones who avoid catastrophic losses. They play defense as seriously as they play offense. Another key part of staying wealthy is controlling ego. Once people make money, they often feel invincible. They increase their lifestyle. They take bigger bets. They assume their past success guarantees future success. But the world doesn't reward confidence forever. It rewards discipline. Staying wealthy also means accepting that you don't need to maximize every opportunity. Sometimes, good enough is good enough. You don't have to win every game. You just have to avoid losing the big one. Financial stability isn't about constant growth. It's about resilience. And resilience comes from understanding one powerful truth. The goal isn't to be rich today. The goal is to still be rich tomorrow. Getting wealthy is about ambition. Staying wealthy is about humility. And the people who master both build lasting freedom. Chapter 6. Tails, you win. When we look at successful people, we often focus on their wins. The big deal. The breakthrough investment. The company that changed everything. But here's something most people don't realize. In many cases, success doesn't come from being right all the time. It comes from being right a few times. This is called the power of tails. In statistics, extreme outcomes and the rare, massive wins are called tail events. And in investing, business, and even careers, a small number of big wins often create most of the results. Think about venture capital. Investors might fund 100 startups. Most will fail. Some will barely survive. But one or two could become billion-dollar companies. And those few wins make up for all the losses, and then some. The same pattern shows up in the stock market. Over long periods, a small percentage of stocks account for the majority of total market returns. That means you don't need to be right every time. You just need to survive long enough to catch the big winners. But this is hard for people to accept. We hate losing. We want every decision to work. We want every investment to grow. But that's not how the world works. Even the most successful investors in history were wrong many times. They made bad calls. They missed opportunities. They experienced failures. What made them successful wasn't perfection. It was patience and positioning. They stayed in the game. They understood that if they kept their losses manageable and stayed consistent, eventually a big opportunity would come. And when it did, they were ready. This principle applies beyond money. In careers, one promotion can change your income forever. In business, one product can define your brand. In content creation, one viral video can grow your channel overnight. The key lesson: you don't need constant success. You need resilience. You need to avoid quitting too early. Because if you quit before the tail event happens, you never experience the breakthrough. The problem is that the path to those big wins looks boring and frustrating. It includes small failures, slow growth, long periods where nothing dramatic happens, and most people give up during that quiet phase. But the math of success is simple: small losses, occasional big wins, long time horizon. That's it. The goal isn't to avoid every mistake. It's to structure your life in a way where mistakes don't destroy you. So when the rare, powerful opportunity appears, you're still standing. You don't need to hit home runs every day. You just need to stay on the field, because in the long run, when tails show up, you win. Chapter 7: Freedom. What's the real purpose of money? Most people think it's about buying things: a bigger house, a better car, luxury vacations. But the highest form of wealth isn't stuff. It's freedom, the ability to control your time. That's the ultimate currency. Money gives you options. It allows you to say no. No to a job you hate. No to a toxic environment. No to pressure that doesn't align with your values. And the power to say no is incredibly valuable. When you depend completely on a paycheck with no savings, you lose flexibility. You may feel stuck. Even if you earn a high income, if your expenses are just as high, you're still trapped. True wealth isn't about how much you earn. It's about how much control you have over your life. And control comes from having financial independence. Even small savings can create psychological freedom. When you know you could survive a few months without income, your confidence changes. You make decisions differently. You negotiate better. You think long-term. Freedom also allows creativity. When you're not constantly stressed about survival, your mind opens up. You can explore new ideas. You can take smart risks. You can invest in yourself. And ironically, that freedom often leads to even more success. But here's something important. Freedom doesn't always look impressive from the outside. It might mean living below your means, driving a simple car, avoiding lifestyle inflation. It may not look glamorous, but internally it feels powerful. Because you're not living for appearances, you're living for choice. Many people chase money to impress others. But that kind of wealth is fragile. The wealth that matters is invisible. It's the savings account no one sees, the investments quietly growing, the ability to walk away if needed. And the best part? Freedom compounds too. The earlier you start valuing time over status, the more control you build over your future. In the end, money is just a tool. If it doesn't buy you independence, it hasn't reached its full purpose. Because the real goal isn't to have more, it's to need less. And when you need less, you gain more control, more peace, more flexibility, more life. That's what real wealth looks like. Freedom. Chapter 8. Man in the Car Paradox. Let's imagine something simple. You see someone driving a luxury car. Immediately you think, wow, that person is successful. You admire them. You assume they're wealthy. You assume they've made it. But here's the paradox. No one looks at someone driving a luxury car and thinks, I want to be like that person so people admire me. They think, I want that car. We don't actually admire the person. We admire the object. And that changes everything. This is called the man in the car paradox. People often spend money trying to impress others, but others are too busy trying to impress someone else. No one is thinking about you as much as you think they are. They're thinking about themselves. This misunderstanding drives a lot of financial decisions. People upgrade their lifestyle not because they need it, but because they want validation. A bigger house, designer clothes, expensive watches. We assume these things will increase respect. But in reality, material displays rarely create lasting admiration. True respect usually comes from character, from humility, from confidence, from how someone treats others, not from what they own. Here's the deeper lesson. When you spend money to signal wealth, you're often sacrificing real wealth. Every dollar spent on status is a dollar not invested. Every upgrade to impress others delays financial independence. And ironically, the people who look the richest may have the least financial security, because appearance and reality are different. Someone living quietly below their means might have significant savings and investments, but you wouldn't know it, because real wealth is often invisible. It doesn't need to prove itself. The desire for status is natural. We all want to feel respected. We all want to feel valued. But confusing material possessions with identity can be dangerous. The most financially confident people don't need to signal success loudly. They understand that peace of mind is more valuable than public approval. The next time you see someone with an expensive car or luxury lifestyle, remember this. You're not admiring them. You're admiring the object. And if you owned that object, others wouldn't be thinking about you either. They'd be thinking about themselves. So instead of chasing attention, chase stability. Instead of chasing applause, chase independence. Because in the end, financial security feels better than financial display, and real wealth doesn't need an audience. Chapter 9. Wealth is what you don't see. When someone looks rich, what do we see? A big house, luxury vacations, expensive clothes, high-end cars. But here's the truth. That's not wealth. That's spending. Wealth is what you don't see. Wealth is the money that hasn't been spent yet. It's the investments quietly compounding. It's the savings sitting untouched. It's the financial cushion no one else knows about. And that's why real wealth is hard to measure, because it's invisible. When someone buys a $100,000 car, you see it immediately. But if someone invests $100,000 wisely and lets it grow for 20 years, you see nothing. There's no signal, no applause, no social media post, just patience and discipline. This is where most people struggle. Spending money gives immediate satisfaction. It's visible. It feels rewarding. But saving and investing feel slow, quiet, boring. There's no instant recognition. Yet the invisible money is what builds freedom. The money you don't spend is what creates options later. The problem is that society celebrates visible success. We reward display. We reward lifestyle. We rarely celebrate restraint. But restraint is where real power lives. Think about this. If someone earns a high income but spends all of it, are they wealthy? Not really. They're dependent. If someone earns a moderate income but saves consistently and invests wisely, are they wealthy? Over time, yes. Because wealth isn't income. It's what remains after spending. It's the gap between what you earn and what you consume. That gap is your power. The larger the gap, the faster you build independence. Another important idea. Wealth gives you time, and time gives you choices. But time only comes from assets that work for you, and assets are built with money that wasn't spent. So every time you choose not to upgrade unnecessarily, every time you delay gratification, you're quietly building something powerful, something invisible, something that grows. The irony is that the richest people often don't look rich, because they don't need to prove anything. They understand that visible spending can actually slow down real progress. So they focus on ownership instead of appearance. Ownership of businesses, ownership of investments, ownership of time. And when you understand this shift, your mindset changes. You stop chasing things that shine and start building things that grow. Because in the end, wealth isn't about what people see. It's about what protects you when no one is looking. Real wealth is silent, but its impact is loud. Chapter 10. Save money. Saving money sounds simple, almost too simple. But in the psychology of money, it's one of the most powerful habits you can build. Most people think saving is about income. They believe, when I earn more, I'll save more. But saving has less to do with income and more to do with behavior. You can earn a high salary and still have nothing saved. And you can earn a modest income and build strong financial security. The difference is mindset. Saving is about creating a gap between what you earn and what you spend. That gap is your safety net, your opportunity fund, your future freedom. And here's something important. You don't save just for emergencies, you save to create options. When you have savings, you can take smart risks. You can change careers. You can move cities. You can start something new. Without savings, even good opportunities feel dangerous because you're operating from survival mode. Saving also gives emotional stability. When unexpected expenses happen, and they always do, you don't panic. You respond calmly. You make better decisions, and that calmness compounds over time. Now here's the psychological part. Saving requires humility. It requires saying, I don't need to show everything I earn. It requires resisting comparison, because comparison is expensive. If you constantly upgrade to match others, you'll always feel behind. But when you focus on your own goals, your spending becomes intentional. Saving isn't about being cheap. It's about being strategic. It's about understanding that every dollar saved today is a dollar working for your future. And the earlier you start, the more powerful it becomes. Because money grows with time, but only if you give it time. Many people underestimate small savings. They think small amounts don't matter, but small consistent savings build habits, and habits build wealth. It's not about one big decision. It's about thousands of small ones. Choosing not to overspend. Choosing not to inflate your lifestyle with every raise. Choosing long-term security over short-term excitement. And here's the truth. The more you save, the less stress you feel. The less stress you feel, the better decisions you make. And better decisions lead to better financial outcomes. It becomes a positive cycle. Saving money isn't glamorous. It won't get you applause, but it builds quiet strength. And quiet strength is powerful, because when life becomes unpredictable, you're ready. Saving isn't about restriction, it's about control. And control is the foundation of freedom. Chapter 11. Reasonable, rational. In finance, we often hear that decisions should be rational, logical, mathematical, optimized. But here's the problem. Humans are not robots. We're emotional. We're influenced by fear, hope, stress, and experience. So instead of trying to be perfectly rational, it's better to be reasonable. There's a big difference. A rational decision might say, invest every extra dollar into the highest return asset. But a reasonable decision might say, I'll invest consistently in a way that lets me sleep peacefully at night. Because what's the point of maximizing returns if you're constantly anxious? If market volatility makes you panic? If you sell at the worst possible time? Being rational on paper doesn't help if emotionally you can't stick with the plan. And that's where many people fail. They choose strategies that look brilliant in theory, but collapse under real-life pressure. For example, someone might invest aggressively because historically it brings higher returns. But when the market drops 30%, they panic and sell everything. Now the strategy fails, not because it was wrong mathematically, but because it wasn't emotionally sustainable. Reasonable decisions consider human behavior. They consider sleep, peace of mind, long-term consistency. Because consistency beats perfection. It's better to choose a strategy that gives slightly lower returns but that you can follow for decades than a perfect strategy you abandoned during the first crisis. Another example, debt. Mathematically, you might earn higher returns investing instead of paying off low-interest debt. But emotionally, being debt-free might give you confidence and stability. That emotional stability has value, and value isn't always measured in percentages. The goal isn't to win an academic argument. The goal is to build a life that works for you, one that feels secure, one that feels stable, one you can stick with through ups and downs. Personal finance is personal. It's shaped by your upbringing, your fears, your goals, your responsibilities. So comparing strategies blindly doesn't make sense. What works for someone else might not work for you, and that's okay. The key lesson here is simple. Don't aim to be perfectly rational. Aim to be sustainably reasonable. Make decisions that balance math and emotion, that allow you to stay invested, that reduce unnecessary stress. Because long-term success isn't about maximizing every move. It's about surviving long enough for compounding to work. And survival requires emotional control. Being reasonable may not look impressive on paper, but over decades, it wins. Chapter 12. Surprise. If there's one thing history teaches us, it's this. The future will surprise you. Always. No matter how confident experts sound, no matter how detailed predictions are, no matter how advanced technology becomes, the world changes in unexpected ways, and the biggest financial events, the ones that shape generations, are usually the ones nobody saw coming. Think about it. Major market crashes, global crises, revolutionary companies, technological breakthroughs. Before they happened, they weren't obvious. They were surprises. And that's important to understand. Because many financial decisions are built on forecasts. People invest based on what they believe will happen next year, next quarter, next decade. But predictions are fragile. The world is too complex. There are too many variables, too many unknowns. So instead of trying to predict the future perfectly, the smarter approach is to prepare for uncertainty, build flexibility, build resilience, build margin for error. For example, if you assume markets will always go up smoothly, you might invest aggressively without an emergency fund. But when a sudden downturn hits, you're forced to sell at the worst time, not because you were wrong about long-term growth, but because you didn't plan for surprise. Surprises aren't rare. They're normal. They're part of the system. And here's another important point. History can mislead us. We often study past data and assume the future will follow similar patterns. But past success stories are visible because they survived. Failed experiments disappear. Unsuccessful companies are forgotten. This is called survivorship bias. We look at what worked and assume it was predictable. But at the time, it wasn't. So the key lesson here is humility. Accept that you don't know everything. Accept that experts don't know everything. Accept that even well-designed plans can be disrupted. And once you accept that, you build differently. You diversify. You avoid putting everything into one idea. You maintain savings. You avoid extreme leverage. You prepare for things that might never happen, but could. Because financial stability isn't about avoiding surprise. It's about surviving it. And if you can survive the unexpected, you give yourself time. Time to recover. Time to adapt. Time for compounding to continue. The future will shock us in ways we can't imagine today. New technologies, new risks, new opportunities. So instead of betting everything on one prediction, build a system that works even when you're wrong. Because in money, and in life, it's not the predicted events that change everything. It's the surprises. Chapter 13. Room for error. One of the most important concepts in money is simple. Leave room for error. Life is unpredictable. Markets are unpredictable. People are unpredictable. No matter how smart you are, no matter how detailed your plan is, something will go wrong, and that's normal. The problem is that most people plan as if everything will go perfectly. They calculate their finances based on ideal outcomes. Best case returns, stable income, no emergencies. But real life doesn't work like that. Unexpected expenses happen, jobs are lost, markets fall, health issues arise. And when there's no margin built into your plan, small problems become disasters. Room for error means having a buffer, extra savings, conservative assumptions, lower debt. It means planning for outcomes worse than you expect. Because even if those worst-case scenarios never happen, the margin protects you. Think about engineers building a bridge. They don't design it to hold exactly the expected weight. They design it to handle much more. Why? Because safety requires cushion. Your finances should work the same way. If your monthly expenses consume every dollar you earn, you have no flexibility. If your investments require perfect market conditions to succeed, you're exposed. If your lifestyle depends on constant high income, you're fragile. Room for error makes you anti-fragile. It allows you to survive shocks, and survival is everything in long-term wealth building. Here's another key idea. Compounding only works if you stay in the game. If you panic and sell during downturns, if you go bankrupt during hard times, if you're forced to restart from zero, compounding resets. But if you build margin into your life, you stay invested, you stay calm, you stay consistent. Room for error also applies emotionally. Don't assume you'll always make perfect decisions. Don't assume you'll time markets correctly. Instead, create systems that protect you from your own mistakes. Automate savings. Diversify investments. Avoid excessive risk. Because success doesn't require perfection. It requires endurance. The goal isn't to maximize every opportunity. It's to avoid catastrophic failure. And that's a powerful shift. When you value survival over optimization, you make smarter long-term choices. You accept slightly lower returns in exchange for stability. You avoid overconfidence. You understand that being slightly wrong is normal, but being completely exposed is dangerous. In the end, financial strength isn't about intelligence. It's about resilience. And resilience comes from margin. So always leave room for error. Because the future is uncertain, and the strongest financial plans are the ones that assume that. Chapter 14. You'll change. One of the biggest financial risks in life isn't the market. It isn't inflation. It isn't even recession. It's you. Because the person you are today is not the same person you'll be in 5, 10, or 20 years. Your goals will change. Your priorities will change. Your values will change. And if your financial decisions are locked into who you are today, you may regret them tomorrow. When we're young, we think we know exactly what we want. The perfect career, the perfect lifestyle, the perfect future. But life has a way of surprising us. Interests evolve, relationships shift, opportunities appear, dreams transform. Yet many people make long-term financial commitments assuming they will never change. They choose careers purely for money, ignoring passion. They buy homes based on status, not flexibility. They lock themselves into lifestyles that feel impressive now, but restrictive later. This is called the end of history illusion. We believe we've finished changing. We think we've become our final version, but we haven't. No one has. So what's the solution? Build flexibility into your life. Avoid overcommitting to a version of yourself that might disappear. For example, instead of maximizing every dollar today, keep options open. Instead of building a lifestyle that requires constant high income, live below your means. instead of taking on massive debt for something that might lose meaning later. Pause. Because freedom is valuable and flexibility is power. When you're financially flexible, change doesn't scare you. If you want to switch careers, you can. If you want to move cities, you can. If your priorities shift toward family, creativity, or peace, you're not trapped. Money should support your evolution, not lock you into your past decisions. Another important idea. It's okay if your financial goals change. Maybe at 25 you wanted luxury and excitement. At 35 you may want stability. At 45 you may value time more than status. That's growth. That's maturity. But if your financial structure is rigid, you'll feel stuck. And feeling stuck creates stress. The smartest financial plans assume personal change. They allow adjustment. They value freedom over perfection. Because long-term happiness isn't about predicting exactly who you'll become. It's about building a system that supports whoever you become. And that requires humility. Accept that you don't know your future self completely. Accept that your desires will evolve. And protect your ability to adapt. In the end, wealth isn't just money. It's flexibility. It's control over your time. It's the ability to change direction without financial collapse. Because the only guaranteed thing about the future is that you won't be the same person you are today. Chapter 15. Nothing's free. We all love the idea of free. Free returns. Free rewards. Free success. But in money, and in life, nothing is truly free. Every reward has a price. And the price isn't always paid in dollars. Sometimes it's paid in stress, sometimes in patience, sometimes in uncertainty. Think about investing in the stock market. Over the long term, it has historically delivered strong returns. But those returns are not free. The price is volatility. The price is watching your portfolio drop 20%, 30%, sometimes even 50%. The price is uncertainty during crises. If you want the reward of growth, you must accept the cost of risk. And here's the mistake many people make. They want the return without paying the emotional price. They invest during good times. But when the market falls, they panic. They sell. They quit. Because they weren't mentally prepared for the cost. Market volatility is not a fine. It's the fee. It's the price of admission for long-term growth. And once you understand that, you stop being surprised by downturns. You stop seeing them as unfair punishment. You see them as part of the deal. The same applies to entrepreneurship. Owning a business offers freedom and potentially high income. But the cost is uncertainty. The cost is responsibility. The cost is stress during slow months. Every financial choice carries a trade-off. Higher returns often come with higher volatility. More flexibility often comes with lower predictability. More freedom often comes with more responsibility. The key is not avoiding the price, it's choosing the price you're willing to pay. Because you will pay something. The question is, what kind of cost can you emotionally handle? Some people can tolerate market swings calmly. Others prefer stable income even if it grows slower. Neither is wrong. What matters is alignment. If you choose a path where the emotional cost is too high, you won't stick with it, and quitting destroys long-term progress. That's why financial success isn't about chasing the highest return. It's about finding a strategy whose price you can afford, emotionally and financially. Because when you understand the cost up front, you're less likely to panic, less likely to overreact, less likely to abandon your plan. Nothing's free. Not growth, not stability, not freedom. But when you accept the cost willingly, the reward feels worth it. And that mindset changes everything. Chapter 16. You, me. One of the most overlooked truths about money is this. The people around you shape your financial life more than you think. Not just friends or family, but your peers, colleagues, and social circle. Humans are social creatures. We imitate behaviors. We absorb norms. We conform to the habits of those we spend the most time with. If your closest friends are spending recklessly, buying expensive cars and flaunting lifestyles they can't afford, you're more likely to do the same. If your colleagues brag about big bonuses but have zero savings, you start comparing, feeling pressure, chasing status, even if it doesn't align with your long-term goals. On the flip side, if you surround yourself with disciplined, thoughtful people who save, invest, and think long-term, you're more likely to adopt those behaviors naturally. This isn't just theory. Behavioral studies confirm it. We mirror the habits and mindset of our closest peers, and this has massive consequences for wealth building. It explains why some people grow wealthy steadily, while others seem stuck no matter how much they earn. It's not just income, it's environment. So the question isn't just, how do I earn more? It's also, who am I spending my time with? Because the answer determines how your financial life evolves. This is why building a supportive environment is crucial. Mentors who teach patience and long-term thinking. Friends who value freedom over status. Communities that prioritize learning over instant gratification. You're not just adopting habits, you're adopting mindsets. And mindsets compound over time, just like money. The biggest leverage isn't always in your income, it's in the influence around you. Choose your peers wisely. Limit exposure to negative financial behaviors. Absorb lessons from people who succeed the right way. Remember, you are the average of the 5 people you spend the most time with. Financially, that average determines how fast you grow, or how slowly you get stuck. Your network is your net worth. The sooner you internalize this, the sooner you'll make choices that matter. Because wealth isn't just about money. It's about thinking differently. And thinking differently often starts with who you let into your life. Chapter 17. The Seduction of Pessimism. Humans are wired to pay more attention to bad news than good news. It's called the negativity bias, and in finance it has a huge effect. People love pessimists, analysts, economists, media personalities. Why? Because warnings are attention-grabbing. Markets will crash. Your savings are doomed. Everything is about to collapse. We listen, we worry, we panic. Optimism rarely gets headlines. Markets steady. Investments growing slowly. Long-term trends are positive. It doesn't sell. It doesn't grab attention. This is what the book calls the seduction of pessimism. Bad news feels smart. Caution feels wise, even though historically the world and markets have grown over time. Most people who get rich don't obsess over worst-case scenarios. They plan for them, they prepare, they build margin. But they don't let fear dictate action, because fear encourages short-term thinking. It encourages selling during downturns. It encourages abandoning plans prematurely. Meanwhile, optimism, slow, steady, quiet optimism, compounds quietly. It doesn't scream. It doesn't demand attention. But it creates wealth. And the lesson is clear. Don't be seduced by constant negativity. Prepare for reality. Acknowledge risks. But don't let pessimism stop you from investing. Don't let fear keep you from building wealth steadily over decades. The world rewards patience, consistency, and quiet optimism. And those who fall for pessimism often pay a heavy price. Chapter 18. Reasonable, rational, reinforced. By now you've heard the idea before, but it's worth repeating. With even more clarity, in money, trying to be perfectly rational can actually hurt you. We think rational decisions are always right. We think math always wins. We think logic can remove emotion completely. But humans aren't machines. We are emotional. We are imperfect. We are inconsistent. That's why being reasonable beats being rational. A rational choice might maximize returns on paper, but if it keeps you awake at night, if it triggers stress or panic, if it makes you abandon the plan, then it's not effective. Reasonable decisions consider both numbers and human behavior. They balance risk and comfort. They allow you to stay consistent. They protect your mental state. For example, aggressive investing may be mathematically optimal, but if it causes you to sell in panic during a downturn, it fails. Keeping some cash on the side may reduce potential returns, but it prevents catastrophic mistakes and allows you to sleep peacefully. This principle extends beyond investing, debt, spending, career moves, entrepreneurship. If a decision is technically perfect but emotionally unsustainable, it's not a good decision. Consistency and endurance are more valuable than perfect choices. Being reasonable means accepting trade-offs. It means understanding your limits. It means choosing a strategy you can stick with for decades. Because in money, survival is the ultimate requirement. You can recover from a small mistake. You cannot recover from catastrophic failure. So focus on reasonable actions. Actions you can follow. Actions that support long-term growth. Actions that allow you to remain calm, confident, and patient. Over time, these reasonable choices compound into real wealth. And this is the final, reinforcing lesson. Rationality without emotional control is useless. Reasonable, consistent behavior beats brilliance every time. Chapter 19. You're not alone. One of the most important lessons in money and life is this: you're not alone. We often feel like personal finance is a solo journey, like every success or failure rests entirely on our shoulders. But the truth is, everyone struggles. Everyone makes mistakes. Everyone experiences uncertainty and doubt. Even billionaires, investors, and financial experts. Most of them just hide it better. Most of them just learn to manage it quietly. This realization is powerful because it changes how you approach risk. Fear often comes from isolation, from thinking, I'm the only one who might fail. From thinking, I must figure this out perfectly on my own. But if you understand that everyone faces challenges, you can approach money with more calmness. You can make decisions more rationally. You can focus on learning rather than panicking. There's another layer to this. Learning from others compounds your growth. You don't have to reinvent the wheel. You can study history. You can read books. You can learn from mistakes others made decades ago. This is the secret of generational wealth. Wealth isn't just about earning money. It's about understanding patterns. It's about observing human behavior. It's about seeing what works and what doesn't before acting. And here's the key point. The financial system is not rigged against you. It's complex, yes. It's sometimes unfair, yes. But knowledge and preparation give you an edge. You're not alone. Others have faced these challenges. Others have built wealth despite setbacks. And if they can do it, so can you. So don't isolate yourself. Don't compare blindly. Don't feel ashamed of mistakes. Use the community, history, and resources available. Learn, apply, persist. Because wealth is not built in isolation. It's built with insight, patience, and guidance, the lessons of those who came before. And this understanding makes the journey less scary, more deliberate, and far more achievable. Chapter 20. The final reflection. We've traveled through decades of financial lessons, principles, and psychology, and now it's time to tie everything together. Here's the final truth. Wealth is a mindset, not just a number. It's not about how much you earn. It's not about flashy cars or big houses. It's about behavior, patience, and understanding how money works. From saving consistently, to embracing your mistakes, to understanding the invisible forces shaping your decisions. Every principle we've discussed points to one idea: control what you can, prepare for what you can't. Wealth is built quietly, invisibly, and steadily. It compounds over years, often without recognition. It's shaped more by restraint than by reckless ambition. It grows through patience, flexibility, and smart decisions, not luck or instant gratification. Remember, pay yourself first. Leave room for error. Accept that you'll change. Be reasonable, not perfectly rational. Build wealth that is silent but powerful. And perhaps the most important lesson of all, the journey matters more than the number. Money is a tool, not a goal. It's a tool for freedom, flexibility, and choices. It's a tool to live the life you truly value. So don't get trapped chasing visible success. Don't be seduced by comparisons or hype. Focus on what actually grows over time: savings, investments, knowledge, and self-discipline. If you take these lessons seriously, apply them consistently, and think long-term, you won't just achieve financial security, you'll achieve freedom of choice, peace of mind, and a life that feels truly yours. This is the essence of the psychology of money. And now, it's time to act. The concepts we discussed are simple in theory, but applying them consistently is where real transformation happens. So start today. Invest wisely, save diligently, stay reasonable, and embrace the slow, quiet journey toward real wealth. Because wealth is not about luck, it's about decisions, discipline, and patience. Thank you so much for watching. I hope these lessons from the psychology of money give you the clarity and tools to make smarter financial decisions. If you found this video helpful, make sure to hit that like button. It really supports the channel. And don't forget to subscribe to Mind Wealth and turn on the notification bell so you never miss our videos packed with insights on wealth, success, and personal growth. I'll see you in the next video. Stay focused, stay disciplined, and keep building your financial freedom.